Okay, guys, I'm going to start. Right, so I'd like you to see who you're talking to. This is me. This is not at my desk. This is actually at a prop firm in London. Unlike a lot of the people that come to these events, I'm in a bit of a unique position because the prop firms are actually my customers. So I end up working with a lot of them. I'm going to bring you some information from those firms today. Now, they're firms that have a slightly different approach to the markets to most retail traders, but there really aren't any heavily guarded secrets there. And these firms that I work with, they're my customers. They've really helped, certainly in my own development as a trader. Generally speaking, if you go to a firm like this, they're very generous with their information. Now, one of the cornerstones of developing as a trader is having an understanding or a philosophy or a belief set in how the markets operate. And today we're going to discuss mine. So we're going to look at an important but overlooked aspect of the markets, something I call market dynamics, or how to conceptualize and understand the massive activity in the markets and the resulting moves, how to make sense of it all. And for one very simple reason, most traders are stuck and going nowhere. Now, this is the result of a survey I held last year, and the results were quite startling. Now, I've met quite a few traders that have actually been trying to learn to trade for over 20 years. Now, that's a huge amount of time committed without any reward. Now, I wonder how many people in the audience today would be happy if you were still trying to figure this out in 10, 15, 20, or 25 years. Now, I know some of you here will have been looking perhaps for 10 years and you want to break that cycle. Problem is, you're not breaking the cycle because without realizing it, there are some fundamental mistakes that you keep repeating, which is this. In the rush to make money from the markets, very few traders try to actually understand them. So they take a technique, try to make money from it, and then they throw it away when it appears not to work. On the professional side, they do something a little different. They learn about behaviors in the market, they learn about cause and effect, they learn about why things happen, and they figure out how to exploit that. Now, most traders, they start out looking for that one idea or one setup that's going to take them from a losing trader to a winning trader the moment they learn it. And I know there's going to be people in here today, just waiting for that one big thing that works. But of course, there isn't that one big thing. It doesn't exist. It's a layer of many techniques and many skills that you have to build as a trader, right? So looking for this one big thing, you can literally look for that forever, which is why people spend 20 years getting nowhere. So what we're going to give you today is an understanding of what a setup needs to achieve to work out, what other participants in the market will need to do in order for your setup to work out. More importantly, we'll help you understand whether that's actually realistic. So it's going to be a bit like a car hurtling down a road at 100 miles an hour and then hitting the brakes and stopping in 2 meters. Is that realistic? Probably not. Well, you're going to be able to look at trade setups in exactly the same way at the end of this session. So what we're going to do now, just go back in time to your first day of trading, or the first day you started to look at trading, to look at this giant pool of easy money and make yourself a fortune. So let's say on that day, you met a wise old trader, and that wise old trader said to you, nobody knows where the market will reverse. Well, how would that have changed the way you approach the markets? Well, for a start, instead of trying to buy the lows and sell the highs, which is your typical rookie mistake, maybe you'd have been following moves that had already initiated. If you couldn't tell where the market would reverse, then you'd have to make money some other way. Doesn't make trading harder, doesn't make it easier, just makes it different. Now, how would we know if this statement was true or not? Well, we'd need to first understand how markets behave. And as I said, trading is all about understanding how a market behaves and then trying to profit from it once you have that understanding. But what does that even mean, how a market behaves? In fact, do we really understand what the market is itself? Well, we're going to answer those questions today. So a big part of trading with confidence is understanding whether a trade makes sense and whether the trade you're in is really working out or not. Now, many people try to do this with statistics, trying to figure out the amount of time something occurred before in the hope that this will be relevant in the future. And I'm going to commit my first act of heresy here and suggest that in trading, statistics are actually of limited use. And to back that up, I'm going to ask you a simple question. You don't have to answer it and type it. Do you trade statistically yourself? And by that, I mean, can your own trading behavior be modeled statistically? Will you yourself trade predictably and according to a rigid mathematical model, even if you've just lost money, or you've just made money, or you had an argument with your husband or wife, or you've got a hangover, or you're working on tomorrow's hangover, or you're really stressed about work, or you've just won the lottery. And the answer is probably not. You know, you're not a robot. You're not going to just be the same. So I'm not saying that there's no place for statistics in trading, but it's really odd that people believe the market's going to conform rigidly to a statistical model or an indicator model, while at the same time knowing that they don't act consistently themselves. So it's not that statistics are bad. It's just that with the markets, there is a more organic side to trading that always gets overlooked, a side of trading that is actually just as important as the technical side. So we need to have a model or a philosophy that explains why moves occur in the market in the first place, why people buy and why people sell, but from a human perspective, not a mathematical one. And it's my belief that if you don't have a way to perceive this huge mass of traders, that a purely statistical or mathematical approach to the market is going to leave you at a huge disadvantage. So if we've got to have some kind of worldview, how complicated does it need to be? Well, we do know that markets are complex places. So in any individual market, you're going to have institutional long-term investors, you're going to have hedgers, swing traders, day traders, HFTs, algorithms, all participating many times all at the same time. One market affects another market at a macroeconomical level, so interest rates, currency rates, oil prices. And then we have technically related markets like the NASDAQ, the Dow, the S&P 500, or Brent crude and WTI. And if you think about all that complexity, it's really quite daunting. But do you actually need to understand it all? Can you trade without knowing what an HFT did in the past 20 nanoseconds? Does your statistical model or your worldview need to take into account all of these different variables to make a decision? And the answer to that is, instead of thinking about what's affecting the market for a second, it pays to think about what the result of all that complexity is. And the result of any activity in the market is binary. It's up or down. So despite all the complexity, markets can really go only up or down. So you can toss a coin to enter a trade and be right about the markets half the time, right? We know that. Yet a lot of traders don't even have a win rate that's as good as random trading, right? They aren't anywhere near as successful as a coin toss. And there's a few reasons that many traders can't get close to random trading results, and we'll look at those as we go. But the bottom line is, yeah, the markets are complicated, but the result of all that activity is actually quite simple. It's up or down, that's all. Now, based on this complexity and all the different kinds of participants and the number of people involved, you can see how terms like crowd psychology become quite commonly used when describing the market. But there are two problems with the term crowd psychology, one that you'll recognize when I mention it. First of all, there isn't one crowd, right? So there's lots of potential crowds with different goals. So market makers, day traders, hedgers, spreaders, institutions, they all have different goals and they all make money from different outcomes. Now, the other issue with the term crowd psychology, and probably a much larger issue, is that whenever somebody mentions it, they never tell you how to apply that to make money trading. So quite often somebody says, oh, crowd psychology. And it's just a clever term that adds no additional value. So today, I'm going to give that some value. And first, I want you to consider something that I call the dominant crowd, because it's my belief in trading that we have multiple layers of crowds, but only one can be dominant at any time. So the dominant crowd can be considered the set of individuals or the crowd that is influencing market direction the most, but it should not be considered in control of the market. So with the futures markets I trade, I consider three potential dominant crowds. First is long-term institutions, which most of the time they're asleep, or rather they're not dominant most of the time. They're playing a long-term game, so they're not changing their mind and switching positions all the time, right? It often takes a Trump tweet or a major economic news event for institutional trading to come in and dominate an entire market. Then you've got short-term speculators, which is basically most of us. So people like you, people like me, that are in the market to make a short-term dollar. People that aren't really interested in the underlying value rising, but just trying to make money from movements in the markets. And in my markets, the ones I trade, that's the dominant crowd most of the time. Then you've got market makers and manipulators. So they tend not to be dominant unless the market is very quiet, at which point the opportunities for them to make low risk profits does increase. Now I'll lump in manipulators here because, again, manipulation is a lot more likely in a quiet market. Now, if you ever saw a market that you're doing well in, and then one day it just went in one direction all day, and you kept trying to trade against it, or you just couldn't join the move, that's basically you not reacting to a change in the dominant crowd, because the moves generated by these crowds are different because a couple of things. First of all, the time between buying and selling are different. Second, the sort of moves or events that cause them to react are different. So obviously a long-term institution is going to buy and he's going to sell next year, right? A day trader is going to buy and he's going to sell that day, right? An institution buying Amazon to keep for 2 years is going to buy and not care what happens that day to the price. He won't react. A day trader buying the S&P 500 is going to get out if the market moves against him. So we're reacting to different things and we're behaving in different ways. Now with the HFTs, their holding times are so short, I don't really include them as being dominant. So their buys and sells are so close to each other that they basically end up being neutral. They do actually provide liquidity. If you wonder why the market was so volatile from October through December, it was basically a lot of HFTs getting switched off, right? So they actually do benefit us. They charge us a little bit for the benefit, and we don't get a choice whether we have that benefit or not, but they are beneficial. But chasing HFTs is not beneficial. But selling algo killing indicators is actually a brilliant business at the moment. Not that I do it myself, but it's a great sales pitch. Now, what would be a reasonable goal when it comes to benefiting from the dominant crowd? Or what would be a reasonable goal from a trade you're about to take? Now, I don't mean percentage return. I mean like a goal, or a goal for the trade, an individual trade you're going to take. So let's give you a kind of dumb example. Yeah. So here's a goal. I want to buy the S&P 500 futures tomorrow with a 4-tick stop and hold the trade for 12 months. Well, I think we all know that that's not going to work, but it's kind of an obvious example. So let's consider a less obvious example. How about I want to buy the low of the day on the S&P 500 futures tomorrow and hold till the high of the day? Can it be done? Well, in a way, it doesn't matter. I can tell you for sure, hand on heart, I couldn't do it, and I've not seen anybody that can. What's important, though, is whether that result or that goal that you're aiming for fits in with your understanding of how the markets move and how predictable they can actually be. So the best way to kind of outline this is to actually just go through what's happening on a typical day. So here's a chart, and this is a typical day, but it's a day where the day is ahead of us, so we haven't opened yet. And generally speaking, what traders tend to do at the start of the day is they've got some levels and some scenarios they think might play out. Levels that a lot of traders set before the day starts. Doesn't matter what market this is. Experience tells us that there's a number of potential levels above and below us that might be significant on any day. And they're usually common, like yesterday's high, yesterday's low, overnight high, overnight low. The ones you see here, they're common on the S&P 500 futures. They weren't common from October to December, but now that the market's reverted to normal, they're becoming a lot more common again. So what happens? Well, first thing that happens is our day opens. Now, what happens when the day opens? We actually get more potential levels that develop through the day that also might be significant. And one of those is the open price. And the open price is a good example of a level that day traders will react to, but long-term institutions won't care about. You know, if we come back to the open, a lot of day traders will initiate new positions. A lot of day traders will get out of positions. If you come back to the open, somebody who just bought like 50,000 shares of Amazon for the next 6 months won't even notice it, right? So that level, or a lot of these levels, they're only going to be relevant to short-term players though. Institutional investors, like I say, they're not going to change their minds if we return to the open. So we keep these levels on our radar because they are potential crowd reaction points. So we have the kind of homework-based potential reaction points that you create before the open, and you have developing action-based reaction points that build as the day progresses, or rather potential reaction points. Now you can use the ones you set before the day, you can use the ones that develop during the day, and you can use none of them, no levels at all, and you can still make money. But what happens when the market opens? First thing that happens, obviously, we get a move. So what we've done now, we've moved through a common level here, a common reaction point. It didn't react, and we're now at another common level. And in terms of the crowd, as we move up, and if you watch this on time and sales, you will see that there are a lot more buy market orders than sell market orders, and the large traders are mostly on the buy side on the way up. So as this move up continues, what is your average trader at home doing? Well, most of the ones I meet are actually sitting there waiting to sell, right? That's despite the fact that the market has upside momentum, despite the fact that all the large traders are buying, and despite the fact that the crowd is clearly favoring the upside, they want to sell. And there's a few reasons for this. First of all, that's what's in a lot of trading books and a lot of trading literature. That doesn't make it right. Second, markets do often reverse at levels, right? So these are potential crowd reaction points, and we know that levels do sometimes hold. They just kind of don't hold consistently. So there's an assumption that because markets reverse off levels, that levels are good places to take a trade. Right, now you've probably never even questioned that before, but right, so yes, the levels can hold. We've all seen levels hold. We all know they don't all hold, but nobody's ever probably asked you, this question, okay, so I see that levels hold. Does that still make them a good place to get into a trade? And there's just a presumption. It's just a presumption that people make because every book they read is about levels and indicators, all this kind of stuff. You don't just take a step back and make like a baseline question of, okay, I can see levels hold. Maybe they're not the best place to get in. Even if they hold, they still might not be the best place to get in, right? Now, I don't believe that levels are the best place to get in, or rather, I've never seen it proved. I've seen a lot of people lose their trading accounts trying to buy and sell levels, right? But regardless, you don't have to agree with my worldview. We should be able to agree that the levels are not the only place you can enter. So you can use levels for many things, and trade entry is just one of those things, right? Now, in theory, people use levels. Another reason people use levels, that in theory, levels give you the most profit potential per trade. And I would kind of agree with that, right? Because if you get in at a turning point and you get a move down, you've got in at the best price, right? But it doesn't mean you'll make more money trading reversals, right? For a couple of reasons. If you're getting on a continuation trade, there are going to be less ticks in that trade because you're getting in after the market turned. So on that one individual trade, yes, there is less profit potential, right? But it does not mean you will make more money trading reversals because there are a lot more continuation trades than reversal trades, right? There's no theory of miss the turn, miss the trade. Reversal trades are also attractive because they've got this very clear get out point, right? You can take a short here and you can put your stop just above that point, just where everybody else's stops are, right? So that's exactly where the sharks are going to get you. So it looks a lot cleaner, right? But it's all an optical illusion, right? Because the markets can only go up or down from any one point. Now, I know you're all used to looking at charts which plot price moves across a timeline. So you're very much kind of programmed to see markets moving from one side to another side and draw lines. But if you can just like put that out of your mind for a minute and just understand that from any one point in time, it's literally up and down. It's like watching something fixed to a vertical pole. It can only slide up and down it, right? It's really important to remember that when you're trying to draw all these shapes and patterns on a timeline, because the market doesn't have slopes, right? Anyway, so it's an optical illusion. Markets can only go up or down for any one price point, and that's true regardless of whether you enter at a potential extreme or in the middle of a move. Anyway, so what's the smart money doing during this move? So on the way up here, if you pull up your time and sales, you're going to see large trades over and over and over again on the buy side. So on crude oil, 20, 30, 40 lots. On S&P 500, 100 lots, 200 lots, 300 lots, those kind of trades. Now, I've met some educators that say The smart money is just the people that bought the start of the move. And some educators call the start of move prices the wholesale prices, and anything after the turn is retail prices, and the only bad traders pay retail prices, that the pros play wholesale. And in my opinion, this is absolute nonsense. After all, 100-lot traders that are buying the S&P all the way up clearly know what they're doing because they're trading 100 lots. So a move up in any market is not going to occur unless there's a significant amount of buying actually through that move, not just at the start. So if the smart money only bought the bottom of a move, then the implication then is that it's only small, stupid traders that are buying afterwards. And the reason that's not true, because if that was the case, there would not be any up move. And I'll repeat that. If there wasn't serious commitment and size to the upside, then we would not continue a move up, right? Markets move up because big guys are buying, right? It's not because little guys are buying. Now, you can see this yourself. You don't have to believe this or anything else I'm telling you today. You can observe it yourself. Pull up a tape, have a look at the size of trades during a move and ask yourself, is that all the dumb money? It doesn't make any sense. So when momentum is to the upside, there's lots of very smart short-term traders, market makers, buying and making the most of a move up. The people losing out are the ones keep trying to sell it, or the ones watching it go up and up and not participating. Now let's consider for a minute how this works from a crowd behavior perspective. So we can observe that smart money doesn't just buy the extremes of a move. We've also discussed that having a bit more of an organic view of the market should be used to complement any technical and fundamental views we have. And you can't get much more organic than sheep, which, as we know, move in herds. So the people that buy at the low of a reversal up, they're the first few sheep to take steps in a new direction from the herd. Other sheep see them move and then move with them. And before you know it, all the sheep are heading in that direction. Now, it's not a bad thing being a sheep or a school of fish or whatever analogy you want to use. So sheep move in herds for safety. The sheep that don't follow are the dumb sheep. It's the sheep that don't follow that get eaten by wolves. So if your organic view of the market fits in with the sort of herd behavior, safety in numbers kind of thing that we see in sheep, if you think about how and why sheep move, it doesn't seem that smart to always try and be the first sheep to move in a new direction. Now, a lot of times, a few sheep will move out of the herd and none will follow. And if we look at the bottom right, we can see we've got a few counter-trend sheep at the bottom there fading the herd. But the chances of them successfully swinging the herd their way at this point is extremely low. So these are the counter-trend sheep that in a clear move up are trying to sell the market. Now, this sheep analogy for the crowd is much closer to the truth than this wholesale retail analogy, which really falls apart when you consider the size being traded during a momentum move. It also makes a lot of sense when you watch the order flow too and see how real size is following a move up. Anyway, our day continues. You've all seen this. We get what looks like a turn or could be a pullback, right? Which is it? Is this a few sheep going against the herd, or is it a new move initiating? Before we answer that, it's worth having to think about why pullbacks occur, or why sometimes you might actually need a pullback. So in a move up, we've got sheep, traders, whatever, initiating long positions. But these sheep are not buyers, right? They have already bought. They are now future sellers. So as a move up occurs, you have a combination of two important things occurring. First of all, more and more of the sheep have already built a position of the size they're comfortable with, and they don't want to buy anymore. Second, some of the sheep start to take profits. So you get a push down. When that occurs, one or two things will happen. And this is very obvious. I'm not teaching you anything new here. So we're either going to see, after a small amount of selling, the market starts to uptick a little bit and the sheep quickly re-engage on the long side. And basically, we've managed to shake off a bunch of future seller stale longs. Some of the people, that take profits, that have been long and take profits, or they've got to their max position size, take profits, they'll start scaling in again, right? Which is why we need the pullback. We need to just shake them off. We need to get them back neutral so they can get back into the market, right? But anyway, people Often people see the pullbacks held and the sheep see the safety of the herd is on the long side, and the long trade is the one that will attract the most sheep. Obviously, the other thing that can happen is we may see more and more sheep selling, and this will continue until the sellers overwhelm any remaining buyers. So more and more sheep see that and believe that now the opportunities to the downside, the herd is shifting. And these sheep, you know, they don't care if it's going up or down, right? They don't want to buy. They're not just buyers. They're not just sellers. Everybody in this market is just trying to figure out which way the market's going, right? So as traders, we're watching this play out. Just like all those sheep, we're trying to assess the movement of the herd. And this is why a lot of people use order flow to watch that activity, engage whether it's a few sheep or all of them. So who are the sheep? Now you're all thinking, well, I'm not a sheep, you know, but it's common for traders to actually visualize themselves as an individual, right? And as the market as something else. So a good analogy would be you're a climber and the market's a mountain. So you're trying to climb the mountain, right? What's a little bit harder to conceptualize, this is a really key concept. This is that if you've only one thing you take away today, I want you to remember this, because this is key when it comes to making money from the market, right? And truly understanding why a market's moving, right? It's a little hard to conceptualize, right? But basically, we're all sheep. Everybody, every trader, every algorithm, we're all sheep in the herd. So you're a sheep, or the trade's a sheep, algorithms are sheep, market makers are sheep. And there's going to be little sheep and there's going to be big alpha sheep. So you and the market are exactly the same thing. And as traders, we have to accept that the market is simply made up of many participants trying to figure out what everybody else is going to do, either short term or long term. And it is only the result of that process that creates the moves, right? That's what you do, right? I mean, I'm going to ask, this is what you're doing. You're trying to guess what everyone else is doing, right? So you're trying to figure out what is going to happen so you can make money from it. But it twists your brain a little bit to grasp that that's what everybody's doing. And there's nobody in the market that isn't trying to do that, right? So there is no the market. It doesn't exist. There's just lots of people and machines trying to guess what everybody else is doing, and that's what makes the moves, right? So the moment you you turn the market into something abstract that's different from you, you've just disconnected it from the most useful thing, which is your own experience and your own feelings and the way you react yourself. It's understanding. Once you can understand that, you can understand how the markets react. Now, as we discussed earlier, it would be crazy to suggest that I could predict what you as an individual trader at home on Monday is going to do tomorrow when you trade, right? So when you sit down on Monday or whenever next you trade, there is nobody on this planet that can tell you as an individual what time you're going to place your trades, what price you're going to place the trades, or how many contracts you're going to buy or sell, or which direction you're going to trade in, right? Nobody knows that about you, right? And it would be crazy to suggest that I could predict that about you as an individual. And let's embrace that fact that we don't know, in fact, what everybody's going to do. We don't know where the market's going to turn, and nobody else does either, because it's all sheep, and there are simply too many sheep and too many variables. And the funny thing is, none of what I'm talking about makes trading more difficult, right? It just changes how you approach the market. It just changes the way you see the markets, right? So where exactly do levels come in? Well, a good level is obviously one that lots of people know. So if it's not a well-known level, then not many sheep will react there. And even with well-known levels, a sheep may ignore it this time round, but take notice next time round. It really is quite random. But what we do know is this. When a market reverses off a well-known level, the sheep are a lot more comfortable going with that move. And that's where levels really help. A move off a level is more likely to continue than a move out of nowhere. It helps with bias. So levels are actually great, but trying to initiate trades exactly at your levels and expecting the market to reverse there and give you 10, 20, 50, 100 tick trades, just not that high probability. You can still get good trades, but why do you need to trade at the turning point? Why do you need to be the first sheep? What's the upside? Well, the upside is more ticks on an individual winning trade, but bigger and more frequent losers. And that's what many retail traders are doing. They're trying to predict where the crowd will turn. Professional traders are simply trading what's happening right now. So when you trade a major turn, you are trading against momentum. The market's moving one way and you're trying to predict a sudden mass change in mind. So it's you and people like that that are turning the market around. You're doing all the heavy lifting for people that jump on board afterwards, and for which I'm sure they'll like to thank you if you're actually trading that way. So at some point, we need to confirm that any counter trend move is a reversal or not. And if it is, there should be sheep activity telling us that it is. So on a reversal down, market sellers should outnumber buyers. Volume on the push down will be relatively high on that first move because there's more sheep. And the size of the push down will be greater than any pullbacks on the way up for that day. In other words, decent push down, good participation, that's what you want to see. And this is, of course, if day time frame speculators are the dominant crowd. Till you see these things, though, you have to be very careful about trading reversals. You might just be seeing a few wayward sheep. So where levels really help is when a reversal occurs near a well-known level, it tends to attract more sheep. It helps confirm that direction has changed. Anyway, back to our example. Regardless of whether we got on board or not, the sheep took the market down and we're now back to the open. Another potential reversal point or another place where a bounce would bring in sheep. So once again, is this high the only place in the move down where the smart money entered? Is this high the only wholesale price and all these prices on the way down are just dumb old retail prices? If so, who are all the people throwing in those 100 lot trades on the S&P or 20, 30, 40 lot trades on crude oil? Are they just like really rich dumb people? If we enter long now, what's the chance we'll get trampled by sheep? So if you think of the market as a herd of sheep, it makes you think about making money out of the market in a slightly different way, a more intelligent way. The hard way is always going to be being the lead sheep, because quite often you'll be out there in front, really happy with a big smile on your face, and you look behind you and there's nobody following. They're all going the other way. So being the lead sheep is enticing because you get to enter on one of these nice turns here and put your stop above it. It looks visually appealing. On the other hand, being a follower sheep means entering with momentum, and there are simply many more momentum opportunities than reversal opportunities in any market. There's just no concept of miss the turn, miss the trade. So when you think of the market as a herd of sheep, you're embracing that uncertainty. You can have your levels, but you don't need them to hold to the tick. They are simply potential reaction points. When it moves underway, small pullbacks, iceberg orders, high volume nodes, all give you the opportunity to enter as long as the sheep is still on your side. Now, sure, there might be new locations to average candlestick trader, but they're not that hard to spot. Now, given this, you've now got a way to actually consider any trade you take in terms of that mass of trades out there, in terms of the proportion of traders that need to simultaneously change their minds or get stuck or carry on what they were doing in order for your trade to work. So some setups you look at will look unrealistic. Right? If it's just some two squiggly lines crossing over each other from a super secret squirrel indicator somebody's told you for $1,000 that nobody else knows about, why would the sheep react? Absolutely no reason. So some things are going to start to look unrealistic. Some might look good but need a little bit more confirmation. And that is one step closer to being a successful trader. Now, that's quite a lot of time to discuss trading without even talking about where to get in, where to get out of the market. But this is basically how professionals approach trading in the real world. And these professional firms, they're my customers. So professional traders, they learn initially through education. Then they trade. But most importantly, they review their trading activity in order to learn more. So I can tell you the best traders I know are way better than the person that taught them how to trade. That's only possible because of this, because they learn from what their trades. They trade, they review, they learn. They trade, they review, they learn. That is the cycle of improvement used in professional firms, right? Each of these elements is absolutely essential for success as a trader, and each of them is as important as the other. Now, you might be thinking, well, that looks like hard work. And it is, but it's the minimum work required to get profitable. You might be thinking, well, that looks like it'll take a long time. Well, professionals do this because it's the fastest way to profit. They don't waste time getting profitable. The slowest way to get profitable is to buy one magic solution after the other and spend 5, 10, 15, 20 years of looking or whatever until you drop out. Now at Jigsaw, we actually give you tools for each one of these components of trading success. What we won't do is work you up into some fever pitch of excitement and sell you some magic zero effort solution to trading success. You will basically get out of trading what you put in once you're focused in the right area. You know, you're already actually putting the time in, right? We're just giving you a structured and proven approach to actually get some money out. So what we give you education. We have basic education all the way up to institutional grade. When I say institutional grade, I mean the same educational material they use in proprietary trading firms. So we give you a professional level trading platform, and we give you the only real-time trade analytics system available anywhere, so you always know where your strengths and weaknesses are, right? Very common problem with traders I work with, closing trades early, moving their stops. Every one of my traders knows exactly the dollar amount that is costing them, right? Because we give them the analytics to show them. That is a real wake-up call. Now, what we also give you on our most popular package is 6 hours of live trading videos. Now, that's not me trading, but a proprietary trader in London, right? And not just any proprietary trader, but one of the best on the planet. Now, if I explain what a proprietary trader is, a proprietary trader is somebody that goes from school or university, gets picked up by a firm in London or America or whatever. I deal with London firms mostly in Ireland. And they get taught to trade. They don't have to pay to get taught to trade. They're just promising individuals. So the firm will teach them how to trade, and then the firm will give them a SIM account, and then the firm will give them money to trade if they're successful. So the videos are of a proprietary trader that is basically at the top of his game. He's one of the best in the world. And what you're going to see is you're going to see his trading while he talks about what he's doing and why. Now, it's not just 6 continuous hours of trading activity. It's the 6 key hours over a number of trading days. So there's like no dead spots. There's no sitting in going, nothing's happening and singing a song, right? And that's from a trader that can swing $100,000 in a day. And over the course of the videos, he actually makes $1 million, believe it or not, on a live account. Now, I'm not saying you're going to make $1 million. This guy is funded by a proprietary trading firm, and he's thrown around 400 or 500 contracts, right? So, you know, this isn't making $1 million off your $5,000 account, right? But that's just the level he's at. It almost sounds too good to be true, but that's just where he is. He's trading a lot of contracts, right? And it was a volatile period. So he's trading on a live account. It's not a SIM account. It's not a demo account. It's real prop firm money. Company whose number one source is revenue off its floor of futures traders. And I'm not sure what that's worth to you, but seeing as nobody else actually got anything like this, we could pretty much name our price, but we don't, because we're primarily to help you and not stiff you. So this is part of our institutional package. It includes those 6-hour videos along with the training course from the proprietary trading firm outlining how those methods are traded. So in that trading course, it's more than 20 setups, plus getting you to understand that market conditions that each of those setups works in, because that's really important, right? And these techniques in this course, they're the actual techniques that prop traders are using today, right? They're not 5-year-old techniques that have gone out of fashion. This is what they're doing right now, not for scalping, but to take bigger bites out of the market. On top of that, we've got 17 hours of education from Jigsaw, lifetime access to our professional grade trading platform, a 1-year subscription to the professional version of our trade analytics system, and a 1-year live trade license. Now, the retail price of those components, now this isn't like one of these ones where I make up all these crazy made up prices for each of these components. These are the actual retail prices of all of those components. If you buy them individually, it's $2,966. And today, we do sell it as a bundle at $18.99. But just for today, there's a coupon code called TTALK. You can get that for $17.99. Just go to jigsawtrading.com/institutional. Sign up today. And with that, I'm going to go over the questions. I've still got a couple of minutes left. Enough with the sheep. Something you're killing me. That's funny. I'll have to use a different animal next time. Perhaps he likes fish. Right. Do you consider smart money relevant signals for different markets, ZNZF? Yeah, I mean, looking at depends what you mean by the smart money. You can only see size. One of the things about size, you can't tell, for instance, if it's somebody putting a hedge or half a spread. So you do have to make some presumptions when you see size go through, and you do have to make some presumptions about exactly where we are in the market. So it's probably, if you want to Skype me on Jigsaw Trading, we can go have a word about that. I wouldn't say, somebody's asking if I'm a momentum trader. I'm not a momentum trader. I do like momentum trades, but I'm just a trader that doesn't like to fade markets that are going in a direction, because they tend to carry on. If a market's going sideways, like for instance, if you're trading the S&P and the Dow Jones is going up and the Nasdaq's going down, very, very high probability that the S&P is in a range. So if the S&P is in a range, you absolutely would fade the market. Then you would really stay away in the middle, because the sheep are going sideways, and then you would play away from the middle. Most people in the world trading make the lying claim they're the one that can be trusted. Scam. Well, that's interesting comments. The trade videos are from a proprietary trading firm in London, right? So these trade videos are not for me. I understand a lot of people being burnt, but like there really is nobody pushing out videos from real prop firms. That's my customers. With that, yeah, if you've got a Jigsaw license, you want to purchase institutional trading, just go to the members page and upgrade to that. With that, I have 1 minute left. I can see we don't have any more questions. I'd like to thank you all for listening. Think about sheep, and just look at the next set, whatever setups you're looking at. Just think about what's going to happen behind the market with all those people just like you for that setup to work. And with that, I will hand back.